name is Adrian Navarre, the CEO and founder of Ticker Trends. We operate the Social Arbitrage Fund, which is a long-short global equity hedge fund based out of Dallas, Texas in the US. In this video, I'm going to go over some cool opportunities that I see within the market, or just wanted to discuss the broader implications of. I plan on turning this into a weekly series where I go over some exciting opportunities or things that I think would be interesting to expand on. And the way that I'm going to talk about these events or these things, I hope will provide value irrespective of when you're watching this video. So even if you watch this in a month or a year from now, from when I upload this video, it's still going to be applicable to a broad time range in terms of the information and value that I try to provide in this video. The first thing I want to talk about is some of the interesting things that we've written about on our Substack. If you haven't seen our Substack is blog.tickertrends.io. And first I wanted to talk about the winter season and the ski market this year because I think it's very interesting. The first thing I want to mention is this idea of using alternative data to gauge interest in certain sectors or industries without using industry-specific alternative data. So what I'm talking about here that might sound a little bit confusing is I think in the hedge fund industry, but in the alternative data industry in general, there is this bias towards having more data is better, or having a more specific data set will provide more accuracy or granularity on a certain thesis that they're trying to prove. I actually argue, or I actually think that this is not always the case. Of course, there are places where that does make sense. But a great example of this is when you're trying to analyze, for example, the winter industry or the winter market, the ski market. So if I'm going out there and I want to see how well is the ski industry going to do this year, I think maybe the typical hedge fund quant or large fund, what they're going to do is they're going to spend tens of thousands of dollars buying weather data or foot traffic data for like these various mountains and places around the world. Now, the issue with that is that there are probably tens of thousands of ski mountains. There are a lot of potential biases that can be within that data. Maybe the weather forecasting is inaccurate. Maybe the foot traffic data is biased because of privacy settings on the phones. What I'm trying to say here is that by getting these more complex data sets, it might actually introduce more biases. So something that I like to propose instead of that is, let's say I'm trying to gauge like snowfall around the globe or around the US. Instead of looking at things, although you could look at weather data and research around that, and I'm not trying to discredit the value in that, I think an alternative is also looking at things that are like ancillary beneficiaries or things that will move with the interest for whatever target variable you're trying to understand. So when I'm trying to understand weather data, I might be looking at things like the purchases of snow tires, or the interest in ski coats, or things like that. So that's a way where I'm using this other data source, right? I'm not actually using the weather data, or I'm not using the foot traffic data for these ski resorts, but instead I'm looking at things that would indicate to me the information that I'm trying to get without having to purchase or utilize those exceedingly expensive but also potentially heavily biased data sets. So an example of this is in our ski article, for example. You could look at things like maybe ski competition is interesting because that might dictate, if more people are getting into skiing, they might be looking at competitions and things like that. And then, of course, when you're just looking at the base like skiing trend year over year, it's pretty abnormally strong. The same thing with ski resort. So those are interesting things to look at, as well as ski pass and lift ticket. Those are also having kind of abnormally strong seasons. And of course, these things can change very quickly. So maybe right now it's been having a strong start to the season, but later in the season it'll be weak. But then you look at things like snow tires, and you can kind of see a similar move there. Something that I also thought was interesting that you can do on Ticker Trends is you can look at like the keyword subdomain traffic or the subdirectory traffic on various websites. So whenever people go on goodyear.com, if their domain contains the word winter in it, then this would be the traffic to that like subdomain of the website. So in this case, you can try to use this type of data to then infer the things like that we mentioned here and talk about in the article as well, which are like general weather trends, and if there is more snow right now or less snow compared to prior years. This is what I think is really cool about the data sets that we focus on at Ticker Trends, which is that I think the general applicability of data sets is very much overlooked. And I think that goes to what I was mentioning earlier, which is like, instead of trying to make things more complex and introducing more biases, maybe simplify it and get information that you're more certain of, and you can actually derive a lot of information and data from that, rather than going the full mile and like purchasing some $100,000 weather forecasting data set. So in terms of the main beneficiaries of something like this, the first step is getting some thesis, which is like, okay, is there a lot of snowfall? Is the winter season strong this year? And then you want to see like what's actually going to benefit from that. A really obvious one this year is things like ski coats. So I am not entirely sure where the screenshot is for that, but you'll be able to see in the trends for ski coats that's something that a lot of people are purchasing. And off the top of my head, a brand that has been very strong in terms of like ski coat trends and something that's doing really well in general. Although I would look for other opportunities as well if you're interested in trading something like this, is Aritzia. They have the Super Puff jacket, which is like a very popular ski coat sub-brand of Aritzia. So something like that is interesting. And there's also other brands like Arc'teryx, owned by Amer Sports. Amer Sports is a really interesting company because they own like Wilson, Arc'teryx, Salomon, and they're kind of in like this interesting trifecta of beneficiaries, which is they have Salomon, which is like this outdoor hiking shoe, and that falls into a bunch of trends because you have running trends, outdoor trends, you have all these things. People want to spend more time outside. They also don't want to buy Nike shoes anymore, so they're going to be buying Salomon shoes, assuming that they market it properly and people actually convert to that brand. They also are in the winter industry with Arc'teryx. Arc'teryx is like a very socially strong winter brand, which focuses a lot on its branding and some of like its technology. And people even wear it actually outside of winter as well, where it's even gone into some of these trends like some of the tech wear fashion trends, which are more casual clothing, but that looks a little bit more technical. And I think Arc'teryx perfectly falls into that as well, and that's why it's been so popular. And it's even grown throughout Asia. I think a lot of the more luxury or winter brands that grow in Asia, that's also where you can see it starts to convert to like a luxury product. And Arc'teryx is definitely something like that, where it's kind of outside of the luxury market. You're not going to say that Arc'teryx is similar to something like Xenia, but I think they have their very own like unique market position. But it's a little bit risky because something like Arc'teryx is something that can easily fall out of trend if for whatever reason it starts to no longer be the type of style that people want to wear anymore. So they have Arc'teryx, they have Salomon, and then they have Wilson. And Wilson has all the racket sports and brands in that. And tennis and racket sports in general have been very strong. And Wilson overall has been growing as well. But of course, the thing you want to look at when analyzing something like Amer Sports is you want to look at the rate of growth for all those brands because the market kind of understands that they're all growing. So they need to be doing exciting things, and you have some of that China risk. So that's an overview of some of the winter market, and I hope that also my analysis of how I look at the winter tires and things like that is interesting. Another kind of more broad trend that I wanted to talk about, which I thought was really interesting, is the value of these content creation platforms, especially platforms that own their own content or distribute content in a way. Although I think it's a little bit different. I would classify platforms that get content uploaded to it a little bit more similar to platforms that own their content rather than platforms that have to purchase their content. So what I'm trying to say here is first I'll talk about this through the lens of Netflix. So Netflix has been one of these companies that has invested the most in producing their own content that they own. And I think the market has realized more and more over time that actually that was the correct bet. Because then you have all these competitors coming into the market and they just can't keep up with the quality of content or also just the maturity of the productions that Netflix is able to do at their scale. And they're all trying to compete for that like subscription streaming market. So there's a lot of value to owning this content. And I think when you look at Netflix, it's like something like where it's a company, it's a content creation company, but since they own everything, they have a lot that they can market. They have a lot that they can sell. So then when you look at these live sports and they started integrating live sports into their platform, it brought a lot of exposure to their regular content. And when you try to compete with these other live streaming platforms, maybe like ESPN or live sports streaming platform or Fubo TV, things like that, those platforms basically their entire content revolves around the sports rights. So if they don't have the sports rights, then they lose basically the entire value of their content. And they have nothing else to sell to their customers besides the sports rights to that content. So what Netflix realized is, we can take these live sports events and use it as a way to sell our other content, like our owned content, in addition to getting that revenue and that exposure from the live sports itself. So it's like it's a dual business. And there you're seeing the value in owning content. But then you see platforms like Twitter, which Elon Musk bought for $44 billion. And now you see more and more of these like mega businesses that are interested in owning their own platforms. And another one is Stake.com. Stake.com is a massive online gambling website. And they, a couple years ago, started Kick.com, which is a competitor to Twitch. Twitch is a live streaming platform owned by Amazon. And the entire reason why they started Kick.com was because they wanted to have a way to distribute content for gambling. Of course, they won't say that that's the reason why they do it. And I think now they've started to market it as like, we're building Kick out to do other things outside of gambling, and it's actually just a content business. But in all reality, Stake.com is a money printer, and they wanted to find a way to turn that into long-term value and not having the risk of being banned by platforms like YouTube or Twitch TV from distributing their content. So by owning your own content, that's what gives you the most security in monetizing the rest of your business. In the case of Netflix, that's owning all of the TV shows and movies that they produce. In the case of Stake.com, which is a gambling website, now they want to own their advertising channel, which is now Kick.com, the live streaming platform. And now we're seeing this again, and similar with Elon Musk as well. He has all these businesses and all these things he wants to monetize, and he needed a platform that maybe didn't have the risk of blocking his ads or blemishing his image. Maybe if he had foreseen that he wanted to work with Trump, he thought that there was a risk of not having any way to distribute his message during that period. So by purchasing Twitter, that gave him a massive advantage in distribution for maybe all of his future plans that he had. So a similar thing here is Rumble, which is a little bit more of like a conservative live streaming or video streaming platform, very similar to YouTube or Twitch. This business, Tether, which is a cryptocurrency business, which has been known to be a little bit more offshore and sketchy, decided to start to purchase a significant stake in Rumble. And I think this just furthers the thing of having your own distribution platform for your message, where Tether is a business that gets billions and billions of dollars, I believe, in profitability per year. When you have a business at that scale, I think there starts to come a point where you want to make sure that you have a way to secure your message and distribution for advertising, and not be beholden to certain platforms like YouTube or other advertising, maybe Google Ads. So by Tether starting to own one of its own content distribution platforms, I think that this is starting to show the value of these types of social media, even in a situation where they're losing a lot of money. Another example of this that I was very interested in, at least initially towards IPO, was Reddit. Reddit at IPO, I believe it was closer to maybe a 10 billion or even below 10 billion dollar market cap for a massive user base, and something that quite honestly I would say is comparable to Twitter in terms of having like a very sticky user base, a very valuable user base, and it was a business that was being turned around by its management. When you look at platforms like this, I think you're going to continue to see the value, so things like Netflix, things like Rumble, things like Reddit, but other social platforms as well. Maybe not as much Pinterest because they haven't done an amazing job of making sure that they have that user base that can be retained very long term, or just doesn't have as high quality of user base. But I think that these platforms are going to be very interesting to watch. And of course, if you want to track the data for this or any of these trends, then make sure to check it out on tickertrends.io. Thank you so much for watching my first trend overview video. I hope you like this format, and I'll continue to produce these weekly, talk about interesting subjects and tips and tricks and things that I think is interesting to talk about, and I'll see you in the next one.